Hey traders, Todd here. Welcome to the Wednesday webinar, the Elliott Wave Wednesday webinar. It is Wednesday, December 19th. This is the Fed day. And to start here, guys, a little poem. I have to read it. 'Twas the night before the Fed. This was last night for the members. 'Twas the night before the Fed when all through the markets, not a chairman was stirring, fearing the White House. Expectations were for a soft rate hike, and hopes that Powell will be there in 2019. The bulls were nestled snug in their bed while visions of a dovish no hike danced in their heads, and the bearish hawks holding their puts, looking to settle December puts deep in the money. Horrible, I know. I wrote it about 11 o'clock last night, but that's all right. So, guys, appreciate the patience here as we're kind of limping into the end of 2019 with this webinar. We are still kind of in a transitional move as we've just changed locations. This is a temporary location here in my new house in Saratoga, and we will be securing office space with a great setup. Lots of ideas for 2019 in terms of taking this broadcast much higher. Higher production value than it is, and lots to look forward to. So today's a huge day. My team is saying I'm a terrible poet. Okay, audio looking good. Everything okay? So a couple things that we will be doing in the future. Again, I love to engage back and forth with you guys. I know there's a feature on the software where I can stream your comments and I can see them right in front of me rather than looking in another location. So that will be coming soon. So again, very much beta mode, but please look for some fun stuff in 2019. I'm really excited about the outlook for this. Okay, great. So it's been busy. Holy cow. We got Fed looking to raise, probably raise today. What is that going to do for the markets? Who knows? I've never seen a Fed, I shouldn't say never. It's been a long time since we've seen such a hotly contested Fed in terms of what are they going to do? Are they going to raise and then say we're going to raise rates and wait? And what does that mean? Does that mean we have a Fed that's continuing to be dovish and is very much focused on a higher stock market to appease the president? Or does a one and wait mean the Fed knows something we don't? And there could be a lot of softness and cracks in the foundation in the economy and something we need to be concerned about. I just came back from the city last night. I was in New York for CNBC's Fast Money, and there's a couple cool topics that came up. And a couple controversial calls that have kind of put my business on the map here recently. In Amazon, if you've been watching Fast Money, we'll certainly take a look at the Amazon call. So what's funny though is you put some pretty out there stuff on Twitter, and the Twitter trolls just come raging out of the woodwork. And I get very sensitive when not they attack me, but they attack technicals because they say it's too subjective. Well, okay, is a rate hike from the Fed from a fundamental point of view a good thing or a bad thing? Either one. It depends on interpretation. It all depends on markets' reaction based on psychology, based on anticipating what's going to happen in the future. So my proposal to you is all forms of analysis are subjective. Barring, quantitative algorithmic funds, the market is driven by psychology, and there's a lot of it out there. So a few things we're going to talk about here. We're going to be talking about, obviously, the technical position from an Elliott Wave point of view in the S&P, Nasdaq, and the rut. I am short the S&P and the rut. No positions in the Nasdaq. My wife is calling me. That's never a good thing at 8:50. Did I mention I need an office? Anyway, so we're going to be talking about that. I'll show you our live positions. We have crude oil on the lows. We broke down about 5-6% yesterday. Huge issue. XLE looks terrible. We're going to talk about that. Housing. We're going to talk about FX. The yen has been very strong, or has the potential to be strong. We're going to talk about FX. We're going to bring in our FX guy, Alex. He's done a video for us, so I'm gonna do that. So we have a lot of fun things to do here. We're going to try to get you out of here in a half hour. Okay. So let me just see if I can get these questions. Oh, there we go. There's some questions right there. Perfect. Pakistan. Wow. How about that? Tesla. Yeah, Tesla's been pretty quiet. Okay. So I think, again, there's about a 30-second lag with questions that will be addressed in the future. So just bear with me there, and we'll get more engaged. So, all right. So let's kind of jump in here. To start from a technical point of view, here we are. I'm looking at two interpretations in the market and the S&P. Two primary counts, two primary Elliott wave counts. Those of you who are new to the stream, we love to engage and analyze the market through the lens of the Elliott wave theory. It's something that is very much, it's something that, how do I describe this very quickly? It's something that requires you to trade with high EQ, not IQ, not emotion and not intelligence, but emotional intelligence. And that's the fact that you have to trade based on all the possible information that can be known at this time. Basically, put that into a trading plan and figure out where the most opportunistic trade entries are that minimize risk. Elliott wave gives us the context as to where we are in a current trend of correction, how far we have to go in that current trend of correction, and if a trade risking our capital makes sense. I always have two interpretations of where the market should go. I think if you ever go into a trade with a singular expected outcome, you're doomed and you're going to fail and you're going to lose money as a trader. Always be watching your back end. Always be second guessing yourself. Always have a backup. So that's going to be, kind of the way that we approach the markets. And I don't think as a trader you should be doing anything but. So my first interpretation is a very conservative one in the S&P. And as I scroll out on the daily S&P cash, actually let's go out to the weekly. Here's what I'm looking at. There could be a possibility that we are about to go into a deep correction. Okay. And I'm not even talking about deep in terms of price. It could be that we are about to engage in a fourth wave here on the S&P that is going to square up with a correction back here in 2010-11. This guy went from May of 10 to October of 11. So 5 to 10. So that's 17 months approximately of a correction. Wave fours can sometimes last longer than that. I'm trying to be conservative on the downside and not say we're absolutely going to fall out of bed. Now, that being said, before I continue on with this count, all I'm looking for is one more push, then we're going to get a significant drop. Here's the thing. We could already be in that significant drop. I don't know. I can't predict the future. Nobody can. But what I can do is identify what the most likely downside target is based on this wave count. And if I get off the weekly back down to the daily, what happens if we're in a big triangle? Okay, a big triangle. If we look at the time analysis of 4v2, which is right here, this is the amount of time that 2010 correction lasted compared to our current correction. Equality in terms of time elapsed from 2010 to 11 at 100% is Feb, not of this year, but of next year, of 2020. A 1.618 relationship, so 17 months times 1.618, which is your Fibonacci multiple, puts you out to the end of December 2020. Possible. Very, very possible. Okay. So if this is in fact a triangle, as you guys know, is a 5-wave move, lower highs, higher lows. Each move is 3 waves. So that brings us all the way back to potentially the first move of the triangle. I have this labeled as A, B, and C. All right, that would be A of triangle wave 4. Looking at some fib, looking at some projections, I told you guys this is pretty heavy Elliott wave stuff. This is the kind of market where you need to be very specific, be very aggressive, and be very deliberate in your trades. And I'll show you what trades we have on, as I mentioned. So as I'm looking at this as an ABC decline, equality between blue A, blue C is at 2478. On top of that is the 1.618 extension of B down to C. Basically what we've done is we've taken A, we've measured and studied A and compared it to C. Measured and studied B, compared it to C. The fib falls in at about 2478 to 88. If this is an ABC, we should go from here down to here. Okay? If I'm wrong, and in fact this is a significant top in the market, we should go to this level and then much lower. And we have positions on right now with our subscribers to take advantage and profit from the move down. We put the trade on around here to get down to here. Okay? If we're wrong and the market really falls out of bed, fine. You know, we're just going to have to reload, reposition for the next leg down. Now, today's Fed. What happens if we get a sharp reaction? It's possible. It's very possible. I'm going to show you the Dow next that we may have just done the ABC move. We might not get down to this level, which is fine. It looks to be we're at about a 61% relationship of A versus C. We absolutely could rally here. I am going in short. I'm willing to bet that we're going to get down sub 25. So here's the actual trades that I have on. Trade SPX. Let's go analyze. Okay, so in the, we're going out to the 31 December options, and the puts, I have an unbalanced fly. I'm long 4 of the 2,500 puts. I'm short 6 of the 2450s and long 2 of the 2400s. Altogether, I'm carrying minus 34 deltas and paying $37 in theta per day. Okay, we're long volatility. 77 Vega. We're trying to get down to the body of the butterfly. Max profit would be 2450. That's what you're doing with butterflies. And that's why I like butterflies so much with Elliott wave, because we have a downside objective based on the wave structure and fib. So I'm calculated. I know exactly what my risk is. I know exactly what my objective is. I know what my reward is. You just have to let the trade play out, right? So we're trying to get down to 2450. My max loss is the blue. If we rally sharply. Right now I have about $3,000 of total risk on this trade. 3,070, and you can look at the blue number right here. So 3,070 is the max risk. Max potential reward, if we get down to that 2450 level, is $16,000 or $17,000. Okay? To get that is going to be very challenging because you have to get the body of the butterfly, these 2450s, to expire worthless, right? So you need to close just above them. That's really tough. But the purple line is a very good indicator of what your potential profit would be as you get through the end of the year and towards expiration. Okay, so 2450 is the downside objective. Any questions? Everybody good with that? Euro, we will do Euro. I'm going to bring that in a second. Lucas, yeah, we're going to do some other stuff too. Let me just get through the top on these guys, on the indexes. Always start with the indexes, guys. Always have an idea. Let me just take a second here. Always have guidance of where the indexes are going. Always have a bias. You always start your trading day with where the index is going. Then you filter through to the strong sectors, If you're bullish on the indexes, or if you're bearish on the indexes, you work on the weak sectors, then you drop down to industry groups, and then you identify the stocks. Always have the market at your back. If you're trying to trade, you find a stock that you like against the current trend of the indexes, going to be tough to make any progress. Okay, so let me just pick up. I'm not going to spend it anywhere near as much time on that, on the other markets as I did in the S&P. But again, is it a triangle? It could be. And I'd love to see the Nasdaq start breaking down NDX to 6440, 6300. That same level, or right around 2475 in the SPX, in terms of 100% A versus C, is at 6067 in the Nasdaq. Again, we may be at a long-term top here in the markets, okay? Let me flip over to the Dow. Okay. From 2015, it absolutely could be the end of the road, okay? I don't know. All I'm going to say is here's a potential to say, based on a good complex correction, ABCX, ABC down in the Dow, if for some reason we get a rally today, this would be a great starting point, right around 2350, 2356, 23,500 from the Dow. Beautiful. W equals Y, 100% right there. 1272 is your common extension for a drop. Beautiful support level right there, okay? So it could go higher or lower. My bet is we go lower. I'm also short the Russell. Russell is one of the weakest. It is the weakest index out there. It closes on the lows like every single day, okay? I have positions on in the rut, as I mentioned. Let's flip back over to Thinkorswim. 15 Feb, so monthly Febs. We've got a butterfly. It's actually a broken wing butterfly, which gives us more of a directional bias, centered around 1,300. So I'm short 10 of the 1,300 puts, long 5 at 1260, and long 5 at 1350. Max potential risk on this trade is about $2,100. Max potential gain is about $22,000. Okay, and again, that's really hard to get that pin, but you know, this is more of a realistic P&L curve, the purple line right here as we get out into Feb. Okay? And you can watch the P&L right there. So why am I centered around 1,300 in the rut? Because we're trading with a plan given to us by the Elliott wave theory. Okay, so here's the rut. We're looking at A, B, C. Guys, it's the same chart on every index. A quality of the initial September-October drop compared to the current is right here at 1302. Just trying to settle down into this range. If the market collapses, fine, we just won't make as much money as we should. I only make $3,000 or $4,000 on the rut. And my max loss was only 21.15. Okay? So again, trading with a plan. If we rally up today post-Fed, I'm going to have to do some scrambling, and there's no doubt about that. Good morning, Ricardo. Let's see. Yes. Which Raif, alternate in the S&P. Yes. I'm actually tracking a few different interpretations. I don't know how much I want to go into this right now. Here's the equivalent in the Dow. If for some reason, and I don't think this is it, but this is Alex who works with me. He does the Forex and crypto service. This is his count, which is absolutely possible. It could be just from Feb of 16. We're doing blue 1, 2, blue 3, blue 4, and we just rally up. It could be. This is an alternate count, and I'm watching this. Okay, so this is the point I was making on Fast Money last night and the week before. Let me actually see if I can show you the actual charts that I sent the producers. The semis have really been a big reason why this market is sold off so sharply, and they've not been participating lately on the downside. So if you look at the semis, here's the point. Anybody see Fast Money last night? All right. So here's from the credit crisis lows in the semis, right? The semis are very cyclical and they have very similar charts. The first decline from 2011 was 29%. This is the next major decline right here in 2015, 27%. The decline so far in the semis is only 24.09%. So we're actually under the recent depth of corrections throughout the rally post-credit crisis. If you were to get a 27% decline, 83.62 is the level. Okay, so if I just try to, it's not going to let me do that. But 83 is going to be right around here. That would just be equal to the prior corrections. So watch the 83 level in the semis. I think it's vulnerable. I think they've tried to hold up fairly well here, really trying to hold the 89. But I tell you what, Micron's news last night did not help. Let's just see where Micron is trading here as we're heading into the open. Active trader. Micron's at 31.85. Okay, and if we just go MU, I think the expected move was $2.50 for today post earnings. We closed at 34.11. So what is that? 31.75. Is that right? 31.75 in MU. And we're trading at 31.80. We're right at the expected move. The problem with Micron, it's the same kind of logic as the SMH. Look at how much more extreme the Micron chart is to these same declines as compared to the semis. So first decline here in 2011 was 67%. 2014 to 15, 74%. What has Micron done so far? 49% decline. That's no good. Okay. This is what's crazy. If you average the prior two declines to 70%, project from the current, that's at 1938. And this is exactly what I was talking about on TV last night. At the current angle of descent, look where 1938 comes in. Like, doesn't that trip you out? Like, you can't make that stuff up. That's amazing. And I find when there's so much confluence like that with technicals, it usually acts as a target. So that being said, like, I'm long chips in my portfolio. We have started doing something new at Trading Analysis. We do short-term trade options to take advantage of 2, 3, 4, 5, 6% moves in the market. But I've also done something where I've taken live capital and we are running a portfolio. So back on November 14th, I put 100,000 in. Total capital invested right now is 51,000. These are live positions. Excuse me, right here. These are my live positions in the portfolio. Okay, but I'm keeping track on a spreadsheet for our members. Let me just take a step back. Like, this is how we do things at Trading Analysis. We are completely transparent. I won't run my business any other way. I just show you my trades. I show you my capital. I show you how much money I have in the market. Like, there's no better way for our subscribers and members to learn by just watching the process throughout and being completely transparent. Anybody else who's not completely showing you exactly what they're doing is doing you a disservice. I hope you can appreciate that. So in this portfolio, and the reason I bring you over to this is we do have some semi holdings, and I'll show you. So I've got 48,000 in cash that is not invested, so I'm 50% cash. I have in my risk on column about 25,000 invested on the risk on side, but on the risk off side, here we go, I'm back. 25,000 invested on the risk on side, and 25,000 invested on the risk off side. I'm holding gold, short high yield, short the S&P via SH, and long bonds. Okay, so I am pretty hedged, but with a lot of cash. If we start to break down, I'm going to reduce some of my long exposure and continue to press the short side with the stocks. But the point of me showing you this is I do have AMD and I do have Intel. The semis have been extremely challenging. Some are weak and some are acting strong. I think AMD and Intel actually act fine. I think they act okay. So let me just bring those over. So here's AMD. I could see this being the end of a correction. And I know somebody just asked me this in to look at some chips. I'm a little bit more cautious on Nvidia, but AMD looks good and Intel also looks pretty good. So I'm a little torn. I'm a little torn on chips. I think they continue to be a little bit challenging. You take a look at Nvidia. Like Nvidia looks terrible. Nvidia looks horrible. There's not much I want to do with that chart right there. Okay. So let's talk about Amazon. My name's been in the news quite a bit lately for this call on Amazon. I mean, it had a ton of views over the last 3 to 4 days since I made this call in on TV. So here's the chart of Amazon. Okay, and if you were to try to draw a trend line in Amazon, what would you do? Would you go from here to here? Okay, support at $500. How would you draw your trend line? Probably something like this. Okay, so support in Amazon at this trend line comes in at about $1,100, depending on the angle of ascent. Now, what happens if that doesn't hold? What happens is that where's the next support? Okay, a trick that is given to us by the Elliott wave theory is this. You can connect the highs of waves 1 and 3, project up from 2, which is right here, and give you a wave 4 target. On top of that, the same percent drop from 2007 and 8 would give you 703 in Amazon. A 23% retracement of everything we've tacked on post-credit crisis would be 782. Guys, Amazon has rallied 5,870% from the lows, from the 35 low, which is right here. 5,800%. Would a 25% retracement seem unusual? I don't think so. So if we in fact are going into a bear market, I think this is incredibly possible. And there's a big asterisk, as I said on TV last night, huge asterisk, that the market needs to sell off. We have 5 waves down in Amazon. We've got A, we've got B, we've got C, we've got a flat, and the bounce so far has been pretty pathetic. Unless it wants to try to carve out an inverse head and shoulders, I don't think so. I think Amazon's got some problems here. He's just STK said, I think you just pointed out the problem with trend lines. Guys, like, I think trend lines are super subjective. I don't know where to draw them. I've only been doing this business for 19 years now. I don't know how to draw trend lines. The first methodology that taught me how to properly draw trend lines was Elliott wave. If you know where and how exactly to draw trend lines, let me know. Okay. So, a couple of things that we're keeping up with our members here. Let's see. Just reading my notes. This crude oil is a real issue. If we look at crude, we dropped about 6% yesterday. It's possible from a crude oil point of view that we are starting to move into a deflationary period, and we're seeing a lot of intermarket signs that we are starting to get some deflationary forces. Potentially, this is a wave 4. I don't know if, holy cow, if this is I hope I'm wrong in this, but holy cow. Maybe. I'm proud to say every time I look at this chart, I say it. Those of you who've been with me for a while are probably tired of hearing it. I was given credit on CNBC as the only guy who called the low in crude to within 10 cents. It was all from Elliott Wave and Fib. I had the 26 low in crude, and it went up to 75, and they did a whole piece on it and made a big deal, and it actually got my website started, really. Got a lot of momentum from that call. If, in fact, this is accurate, we might need to make another one down there. The other thing I want to show you is XLE, which is the energy ETF on a monthly. You guys want to see an ugly chart? Oh. I'm not doing Elliott Wave here, just doing traditional technicals. That's XLE on a monthly. Look at that in purple. Look at the 200 period EMA on the monthly. Yeah. We haven't been below the 200 month EMA since June of 02. And it looks like we're doing a massive head and shoulders here. There's nothing good about that chart. That's scary. And I'm not trying to be sensationalistic. And, you know, again, I'm getting kind of sick of Twitter. I'm really enjoying YouTube, but Twitter can kiss my butt. People, when I get on TV and do this, people are like, oh, you're trying to push your agenda, you're trying to scare people. And I'm like, no, man, I'm short. I just showed you my short positions in my option trading account. I'm pretty leveraged up. I'm short. I want to make money. I don't care if we go up or down. I really don't care. I'm trying to make money and generate a return for myself and my subscribers. So just know I'm not out here trying to scare anyone. I'm trying to make money for you and me. So that's that. Okay. Other things I want to hit real quickly, then I'm going to bring some FX in here. Gold potentially has the move to go. Gold has been quiet for so long. It's had so many opportunities to rally. Just can't do it. I'm actually still holding a bearish look on gold. I think deflation, I don't know. If deflation can rally up gold, it's got to break through this 1300 to void this bearish triangle to get me bullish. But I do think there's a possibility for gold to run up through 1300. I do know GDX, the miners, some I think Feb or January calls have been under some heavy accumulation. The chart on the longer term doesn't look great. But it does have the possibility to move up to like 23 and a half. So watch GDX. Another one that I want you to keep an eye on is FXY. That's the yen ETF. Okay. Let me get S&P out of the way. So the FXY is in red and white, and TLT is obviously in blue, and the S&P, come on now. Stop. Okay. So we actually get bonds and FXY trading in the same direction for deflationary forces, which is falling price levels. If we are in fact don't have inflation, but in fact disinflation or possibly even deflation coming, we're going to get that recovery in bonds. I do have bonds as a big ABC down. TLT usually can lead the FXY, and we're starting to see that a little bit. So if the bond market is going to rally, we could get FXY moving up, and that would be a risk-off scenario. Certainly watch that. Crude oil breaking suggests that to be the case. You look at just a couple sectors like IYT, transports, should be able to rally with falling crude. It just made a new low not seen since last year. Where the S&P just barely made a new 18 low, we almost just broke the late 2017 low in transports. Banks look terrible. This is the regional bank, KRE, looks absolutely terrible. I know I have some Elliott Wave counts on this, on KRE, but they're being shy right now. Yeah, they don't want to come out. That's okay. The other thing I'll point you out to is J&K junk and high yield bonds. The ETFs made new lows. So if we just do some J&K, look at this daily chart on J&K. Just made a new low again yesterday. Looks terrible. HYG high yield bond ETF. If I could type, looks terrible. So I think the balance is for risk off. There's too much broken. There's too many broken sectors out there that don't look good. Okay, so that's the main things I wanted to hit. I'm gonna do something I haven't done before. I don't know if it's gonna work, but we're gonna try it. I will be bringing guests in the. I will be bringing guests in on this when I get a little bit more confident in the software. It will be coming in the future. But Alex runs our FX and crypto service. I'm pretty proud to say that Alex had buy orders in crypto at 3,100 in the Bitcoin market. And we just missed it. He just sent out a text. We're canceling orders to buy Bitcoin at 3,100. Our order was missed by just a margin. We've invalidated... We have invalidated tape for now, bearish count. Okay. So, he's good. He's very good. So, I'm going to play an FX video for you. Again, it's pre-recorded. I don't want to take the chance of screwing up the interview here or the webcast today until I get better at this. I don't know how this is going to go. Wish us luck. And let me know if you guys can hear the audio. Team, can you guys hear Alex? Let me know. Just give me a quick message in Slack. Oh, here we go. Okay. Not seeing audio or not hearing audio. Let's try this.
Meeting, and in the next 2 months in the dollar and the euro. This is the dollar index chart on daily. So I think we are here in a corrective process. Actually, the Fed might hike tomorrow, but with a dovish stance, which might pull a dollar index down. So I see this as a orange wave A, and all of this what's going now, it's a part of a orange wave B. We have stopped at 127.2 fib relations, which suggests this potentially can be a flat. So we are down in blue A, up in blue B, and we need 5 waves down to roughly 92.50 to complete this orange wave B. So my take is dollar down, but temporarily. If we look euro, I will just raise your attention to the overlay between the price of the German Bund 10-year, which is equivalent to the US bond 10-year. So we can see here that from the highs and the lows in the price of the Bund, euro was constantly falling down and the price of the Bund was going up, which means yields on the euro was falling, and consequently the euro was falling as well. I see potentially one more move lower in price to complete this triangle, because we have 1, 2, nice 5 waves in 3, consolidation in 4, and then potentially one more move up, which means this is going to additionally bring yields down and consequently euro down. This fits well with this outlook that temporarily on Fed we might see a euro spiking up to 118, 119 level, and then consequently one more push lower to 108, 107 until the, let's say, June, July, August 2019 in accordance with this relation from Bund and yields, which I have displayed. Also, I think that we are going to be in the first half of 2019 in deflationary environment. As you know, oil is down, so lots of things for this outlook to unfold. That's my take, and see you guys next week. Bye bye.
That was the least quality production way I could do that, but we will improve. We will improve. Alex, thank you for that. I'm kind of seeing that same thing with the dollar, or with the gold market. I do believe we have the potential to squeeze up, as Alex was mentioning. So, all right, guys, we're going to leave it there. Let me know if you have any other questions. Thanks for that, Zach. Very nice comment there. You should join TA membership. Great community and price respectfully for the content. I truly enjoy it, especially through the correction. I'd be toasted without Todd on my side. Thank you, Zach. Very nice. So yeah, guys, that's where we're at. Just kind of getting through this choppy market. It is still choppy. We've not really engaged in a trend since October. But we're starting to act a little spicy. We will see what happens. We have, of course, given back probably half the gains in the futures ahead of the open. Let's just take a look at that chart before. It's going to be quiet until the announcement, which, probably 1:15 or so. Let's go over here and let's go active traders. Yes. Yep. There we go. So we went up to 62 and we're now down at 51. Okay. And that's really been the theme over the last week or so, is rally in the Globex pre-market and sell them in the regular session. So we'll see. We'll see what happens in this grand monetary policy, now fiscal policy, grand experiment, the likes of which have never been seen before in the world. But who knows? All we can do is trade it and deal with the information that we have at hand right now and make the best decisions possible. I think the outlook is lower, and it's all about how you handle it and position it. So you saw our positions, you saw our outlook. We looked at a lot of markets. Hope you enjoyed it, guys. Be sure to check it out. Also, I am working on a YouTube vlog. Those of you on my YouTube channel, check it out. When I was down at Elliott Wave International, I was actually hanging out with Bob, with Prechter, Mark Allman, his corporate director, a bunch of guys. We had a great time. I vlogged the whole thing. We wound up, you'll have to wait and see, but we wound up on a boat in Lake Lanier in north of Atlanta. We wound up poaching someone's dock to run from a storm while drinking some adult alcoholic beverages. So that will be on the video. I think that footage probably has never been seen. So, and also put out the interview with Bob Prechter that I did on the anniversary of the 1987 crash. So be sure to check out the YouTube channel. I'm working on that. And best of luck, guys. Thanks for listening. And again, this is just beta mode. We're just getting started on this broadcast, just trying to figure out our way here. The production quality is going to be pretty awesome here in 2019. So thanks. And how do I stop this thing?